Good afternoon, everyone. Talking about dark arts, I'm going to be chatting about accounting this afternoon. So hopefully that will have some interest or relevance to what you guys do. I appreciate it's 3 o'clock in the afternoon and it's a bit of a dead zone. So anybody wants to stand up or shake it off, please feel free, because it is a bit that time of the afternoon. I'm going to just have a bit of an overarching chat about the producer's offset. I know other people have covered bits and pieces today, so I'll go through those fairly quickly. The eligibility, again, Oscar has covered that in his talk this afternoon. Then I'll go through the provisional final certificate, and I'll do it on a bit of a timeline basis from the accounting point of view. And then I'll go through just some specifics on qualifying expenditure. Just a bit about myself. I'm a chartered accountant. I've worked at KPMG, Deloitte and Moore Stephens, but I've also got a bit of practical industry experience. I've got a master's in producing from AFTRS. I've produced about 22 short films and associate produced a couple of features. So that's a bit about myself. Okay. So the producer's offset, what is it? It is a tax rebate. As most of you are probably aware, it's used as an incentive to drive film production. Film production obviously has value to the economy. Oscar did run through the Screen Australia incentive and why they put money into film, and it's a similar rationale for the tax incentives. People like to see Australian stories on screen, and it does drive a significant part of the economy. There are three main federal tax incentives. They are the location offset, and I know we ran through the location offset this morning. It's mainly aimed at larger US productions. There's a guaranteed 16.5%. That's not quite competitive on the world market. You can generally get 30% from certain locations. So there is basically a top-up fund which the government has put together, which is the $35 million a year for 4 years to try and attract the footloose international productions. They did lose the Martian up in Queensland because there's a certain uncertainty about whether you get a top-up or not. There's a lot of people arguing that it should be a definite 30% or something similar, but that hasn't come through yet. There's the post-digital and visual effects, or the PDV. That's mainly aimed at post-production. So if you're looking at doing things like shooting in America, you can come out here and do your post and get 30% of your post-production back. And that applies to things like features as well. So a lot of visual effects, they might be shooting a Batman or a Superman, and they'll come out here and go to some of the bigger post-production companies and get a 30% rebate on that. The tax incentives work basically as a percentage back on budget, especially the producer's offset and the PDV. So it's basically a certain amount of your spend. You'll get that back when you do your tax return. I'll go through that in a minute. Why is it set up like that? I wasn't around for the 10B and the 10BA, but from what I understand, when you've got a tax deduction for your actual investment, there are a lot of tax deductions got claimed on films that didn't actually get made. So I think the government said, rather than actually give you a tax deduction up front, we're actually going to wait until the film gets made and then give you a rebate. Obviously, that causes issues for on the funding side, which is why you've then got to get it cash flowed and everything like that. But my understanding is that's the way it's been set up, as a tax rebate, and not some sort of deduction or incentive like that. Again, Oscar did run through eligibility in his seminar this afternoon. You've got to have significant Australian content. There are the 5 categories, which is where the story is located, whether it's Australian people involved in the shoot, where you're shooting, things like that. My experience has been most Australian films generally qualify fairly easy for significant Australian content. Like, even if you're shooting a sci-fi out in out in Broken Hill, you're going to qualify under enough of the significant Australian content criteria to qualify. So A lot of producers I meet worry about the significant Australian content, but I've actually seen it be an issue on almost no features that I've been involved with. Probably more of the challenge for a lot of the producers I work with is hitting the $500,000 quote. So you've actually got to have qualifying Australian production expenditure of $500,000 or more. I work a lot at the independent end of the market where people might do a shoot for 150 or 200,000 when they're going into post and they're not sure if they're going to be up over the $500,000. So obviously on larger productions that's not an issue, but at the independent end of the market, a lot of producers are trying for the $500,000 and trying to structure their financing and their shoot and their expenses to get over the line on that one. Big issue for a lot of producers obviously is whether they can get feature film distribution, because the producer's offset has two rates. If you can prove an intent to distribute theatrically, then you can qualify for a 40% rebate on your qualifying expenditure. If you don't get that 40%, but you're still distributing the film in Australia, you can qualify for a 20% rebate. And that's obviously a huge difference to a project, whether it gets 40% back or 20% back of their qualifying expenditure. So just looking at the typical process from the accounting perspective, accountants very rarely get involved in the script or the development phase. So we generally get pulled in quite often when somebody's going for a provisional certificate. Now, the provisional certificate is where you're basically pre-qualifying for the producer's offset, so they can look at the project, and Screen Australia will say, yes, if you make this project the way you're going to make, you say you're going to make it with this financing and this distributor, then it will qualify for the 40%, or no, it won't because that distributor's not sufficient for our purposes and that sort of thing. A lot of investors love to see a provisional certificate, because if you're pre-approved at provisional stage to get the 40%, Screen Australia won't come back at final and then revisit that generally. So if you get pre-approved for your 40%, unless you do something significant like change distributors or make a different movie or something like that, they don't revisit that when you do your final certificate if you've been pre-approved at provisional. So from an investor's point of view, and the producer's point of view, if you've got the 40% during provisional, then that's fantastic, because that gives you a level of certainty on the producer's offset. From the accountant's point of view, there's actually not a lot of accounting information that goes in at provisional. So even when people contact us and say, oh yeah, we're going in for provisional, I go, yeah, that's great. You don't really need anything from me for that. So that's provided, they're providing budgets and things like that. And distribution agreements and things like that. So that's the provisional certificate.
Just on the provisional question, Matthew, and maybe Screen Australia, is there circumstances where you have to get a provisional?
No, not that I'm aware of.
Any of your funding that's tied to getting a provisional?
We have to get a provisional certificate for investments.
Okay.
So the answer to that question for the mic was that Screen Australia do require a provisional certificate for all investment projects, but not for grant projects. Thanks.
Yep. Just on provisionals, quite often with the smaller projects, it's a matter of timing, and by the time the distributor comes on board, quite often it's too close to the shoot to get provisional, or sometimes the distributor's not even coming along until you've already shot the film or you've finished the film, and there's not much point going for provisional when you can actually go for final anyway. So timing often plays a factor on whether you go for the provisional certificate or not. So as an accountant, I normally get involved somewhere during pre-production. On a lot of smaller budget films, we'll sit down, we'll look at the budget, and we'll do a plan on how to do the accounting. Personally, I use the Xero accounting system and then have some Excel spreadsheets to add on to do the cost report. There's other software available like Midas, and then you can go into more software again for the larger projects. A lot of projects like to track the quote during the shoot, and sometimes I know some of the lenders like to get quote spreadsheets throughout the shoot. On a lot of projects, the actual non-quapeable number of transactions might be fairly small, so it might not be worth actually tracking every single quape item, because if there are only a handful of them, they're fairly easy to identify and post. So it's sort of on the smaller projects, you do have a bit of flexibility as to whether somebody needs a quape report every week or whether they're just going to go for quape at the end of the shoot. Post-production and reinvestment is, I think, an interesting one. So quite often I get a lot of projects that come in and they've actually finished the shoot, they've spent, say, $200,000 on a shoot, and they go, we've run out of money, and we want to go for the producer's offset to try and fund post-production. So that's where, quite often the lawyers get involved. They start doing deals with post-production houses to get reinvestment deals going on, to try and get from that, say, shoot cost of $200,000 up over the $500,000. And that's quite often a lot of wheeling and dealing by the producer, and the post houses coming in with reinvestment deals to reinvest a certain amount of their fees and things like that. Sure.
So to get to the 500,000 minimum quape, if you spent 200,000, you say they're spending 300,000 on post-production?
Yes.
And doing that through a reinvestment?
Yes. Yeah, I mean, when you're looking at, that, so that's...
Put the raised eyebrows onto the mic.
Yeah, I mean, you're looking at all your shoot posts and then all your sound posts, and if they've got any digital effects and things like that. So quite often it'll be made up of several items. But yeah, it's not, I don't think it's unusual to actually have a shoot cost of 200,000 and still qualify for as a producer's offset project.
It is very closely scrutinised by POCU and screeners, reinvestments, because obviously there's scope for abuse.
Yeah.
So Rebecca's just noting that it does get scrutinised, the reinvestment deals.
Yeah, so the reinvestment obviously has to be at market rates. So obviously there's the potential to inflate invoices and things like that to try and get over the $500,000. So firstly, if you're reinvesting, you're becoming an interested party. So you actually have to especially note that when you do the final application, going, I'm also an investor, therefore here are my interested party transactions. So they're separately noted in the final application. And if a single investor is over 50% of the overall investment or financing, then Screen Australia can actually ask to see the ledger of the investor where they're incurring costs as well. So say if a post house comes in and spends $800,000 on $1 million shoot, on a $200,000 shoot, Screen Australia have the option to go in and actually look at the ledger of the investor and say, how did you spend that $800,000? What's your wages cost? What's your hire? And things like that. So there are mechanisms in place to make sure that people aren't inflating this to abuse the system. When the producer offset came in, quite often post-production houses or the producer would actually go out and get 2 or 3 quotes from other post houses if they were doing a deal, and say, I've had a quote from post house A, B, and C, and they all came in at 300,000, and I've done a reinvestment deal with post house D, and that's 300,000. Therefore, on that basis, we believe it's a market rate. Producers seem to be doing that less and less, going out and getting those quotes. Some still are, the more conservative are, or the more risk adverse are, but it doesn't seem to be done every single project, which it used to be. It used to be, that was part of the process, was you'd go out and get some market quotes to make sure that you're at market rate.
And my understanding is there's actually a guidance note on interested parties and what you're required to establish. Is that right?
Yes, Screen Australia website.
Yeah, on the Screen Australia website. So whenever you've got an interested party, whether they're providing archival facilities or whatever they're doing, they're looking for market rates between the producer and that interested party, aren't they?
Yes. And quite often, the producer and the director and maybe the writer are reinvesting as well. So they're quite often interested parties as well. And again, Screen Australia looks at market rate for all of those. Delivery, one of the key dates you look at when you're doing producer offset is when the project is available to be delivered, which means when it's actually finished the post-production process, you've finished your picture edit, you finish the sound, and it's ready to be delivered to the distributor. It's an interesting wording in that it's not the date of delivery to the distributor, it's actually the date when it's ready to be delivered. So you can't actually have the film there and sit on it for a month or two for whatever reason. So you actually have to say when it's ready to be delivered, and normally you get a letter from your post-production house saying that the film is ready to be delivered. And that's the evidence you normally provide Screen Australia for delivery date. Delivery date is really important because you actually get to claim the producer's offset in the year you deliver, or the year you're ready to deliver. So if you're looking at delivering close to 30th of June, you really want to make sure you deliver pre-30th of June, because if you deliver on the 1st of July, you then actually have to go into the next year's income tax return to make a claim, or you have to look at liquidating the company, which I'll talk about in a little bit. So once the film's delivered, the process is getting the application ready for producer's offset. My experience has been, after delivery, this generally takes about 4 weeks. Screen Australia have a fairly high level of documentation. There are maybe 60 documents they require for a producer's offset application. You're looking at, ASIC statements, chain of title documents, above the line accounting contracts. You're looking at things like crew listings with nationalities and residences, marketing plans, and then on the finance side, you're looking at the general ledger, the final cost report, the QAPE spreadsheet, and things like that. And that QAPE spreadsheet also has to be audited by a registered auditor. So in my experience, after delivery, it generally takes, on a good project, about 4 weeks to pull all of that documentation together and get it into Screen Australia. Screen Australia then generally take about 12 weeks to review that. That process, generally you put it in, and mostly you don't hear from Screen Australia for about 4 or 5 weeks, and then they'll come back to you and they'll say, we're looking at this person assessing it, is there any conflict of interest? It goes out to that assessor, and that assessor will then review all the documents and come back with questions. Mostly they're questions about whether items are quapeable or not, and I'll go through, the next slide is actually going through specific examples of what's quapeable and what's not quapeable. The assessors are generally fairly fair. I have had some assessors come back and go, oh, you've actually said that's non-quape, and it actually is quape. So I have had some assessors bump up our quape from time to time, but that's a bit unusual. But it does happen. Once you get the final letter from Screen Australia saying what your qualifying expenditure is, you'll then actually prepare a tax return for the year of delivery. Timing-wise, this can be a bit interesting, because let's say if you delivered in 30th of June and it took you a while to pull everything together, maybe you don't go in until September, October, the producer's on another shoot or something like that, then Screen Australia aren't doing it till December or January or something like that. Like, sometimes this project can be delayed. There isn't a time limit. I've actually gone in, I think, 3 years after a project finished for producer's offset, and that's fine. There isn't like a deadline of when you have to go in. But obviously, if it relates to a tax return, sometimes you might actually have to delay the tax return to wait till you get the producer's offset certificate from Screen Australia. And that does happen sometimes. I have had that happen a couple of times, and the ATO has fined us for submitting the return late. And each time I've been able to go back and say, well, actually, we were delaying it because we were waiting for Screen Australia to finalise the process, and I've generally got those fines refunded. So if you do have to go late, there is a process, and the ATO generally understand that. So you put in your final tax return, you've got your paperwork from Screen Australia, and then you just wait for the money to come into the bank, hopefully. Obviously, one of the reasons you set up an SPV is the way the producer offsets works. If you didn't set up an SPV and you had an existing tax debt, they would take the money off for that tax step before the producer's offset money came in. So if you had been running it out of your normal production company and you owed $100,000 out of your normal production company, they'd take that money off the producer's offset and give you the net amount. So that's one of the reasons why investors like you to set up an SPV. Another reason to set up the SPV is, like I mentioned, let's say your delivery slipped and you couldn't deliver until the 2nd or 3rd of July. If you hadn't set up an SPV, you'd have to look at either waiting for 12 months, and if you've borrowed money, you don't want to be waiting for 12 months and paying interest, or actually winding up your production company, which could be a hassle because you could have lots of other projects going on and that sort of thing. So if you've got the SPV set up, you can actually liquidate the SPV and put in a final tax return as part of the liquidation, and then get your producer's offset as part of the liquidation process. Generally, if you're delivering in the first 6 months of the year, it's worth looking at whether you should liquidate the SPV. If you're liquidating in the second half of the year, or you're still going through Screen Australia, quite often the producers go, oh look, it's only another month or two, and I can put in my normal tax return, I'll wait. So generally I've found liquidations are more common, obviously, if you're earlier in the financial year.
I think just one question on that. Apart from the advantages of winding up the SPV and getting the money earlier, I know that there is a different practice amongst producers. Some always do an SPV, some run it through their main account. And is there any disadvantage in running it through the main account other than the investors not wanting you to get tax credits on their offset or whatever, if that's going to go into the finance plan and pay your financier? But yeah. Apart from that...
So the main other advantage of setting up an SPV up is actually when you're looking at doing things like invoicing for overheads, and if the production company has actually employed the producer or the director and the charge is coming through the production company to the SPV, it's actually a lot easier to document because you've got an invoice coming from one company to another company. If you haven't set up an SPV and you're trying to make a claim for overheads, it's a little bit harder to document. You can do it. So just to explain, one of the things you can claim on producer's offset is 5% of the budget you can claim it as overheads, and that basically recognises all the time and effort that the producer has done in getting the project up. So rather than the producer actually trying to claim time during development and things like that, Screen Australia sort of said, in recognition of that, you can claim 5% of the budget as a producer's offset that generally goes back to the production company or the producer. And so if you've got an SPV, you can just do an invoice from your production company down to the SPV. If you haven't, then you can't invoice yourself is the issue. So if you're a production company and you're trying to do an overhead, you have to go, you actually have to do, well, the way I've done it previously is you actually do sort of a manual adjustment in between your general ledger and your QUAPE spreadsheet, because that 5%, well, you can't raise an invoice to yourself, so how do you recognise that as part of QUAPE? So I've done a separate reconciliation saying, here's my general ledger, I'm adding 5% QUAPE and here's my QUAPE, but then the QUAPE doesn't actually match the general ledger. There is one other advantage as well in that if you set up an SPV, all the transactions in that SPV and in your ledger relate to that project. So when you're actually doing your reporting, you just basically go, here's my general ledger, my subset of my ledger is the same as my general ledger, and from an accounting perspective, it's a lot easier. Whereas if you hadn't set up a separate general ledger in the SPV, you're actually going, oh, well, I've accounted for this project over here, so see these accounts in the general ledger, but here's my, they might ask for your total general ledger and the subset to look at things like that. So from an accounting perspective, it's a lot cleaner, quicker, easier to set up the SPV as well. So I always recommend setting up the SPV for those, because there's 4 or 5 reasons to do so. Sorry.
Given we've got Fulcrum in the room, I was going to ask a question. I thought that one of the main reasons for setting up an SPV was because financiers prefer you to have a clean skin company without any...
Yeah, so the primary reason why Fulcrum requires producers to have an SPV is because we don't want the SPV to be consolidated for tax purposes, and that protects the offset funds from being seized by the ATO if there was some other tax liability that the producer had.
So I think we can guarantee a lender will always require it. Sonia?
Yeah, I just wanted to maybe just add to that as well. Just a lot of films in particular have 2 SPVs now. So it's important to ensure that the structure is the shareholdings are approved by the lender. So it may be that one share, so instead of just being wholly owned SP holding company and production company, that one share is held by an individual or another entity. So there's no possibility of that group being consolidated for tax purposes.
Thanks.
Okay. And just for my final slide, I thought I'd run through a couple of most of the issues that you get for certain expenses when you're looking at getting your qualifying expenditure. So, documentation of expenses. Obviously, this is, you're putting in a tax return. You've got to be able to document all your expenses. You're going to go through an audit process. Documentation of expenses is quite important. From the accounting point of view, you need a lot of detail in your general ledger so Screen Australia can actually determine the nature of the expense. So, for example, you can't just go out and your general ledger say, I gave the production designer $1,000 and they spent $1,000, there's $1,000. You actually have to itemise all the expenses. So, you need the level of detail where you're actually going, I bought a jumper for the character Clarence on the 23rd of June and things like that. So you actually... and this is where a lot of the accounting work goes on, is the level of documentation required is probably a lot higher than normal, because Screen Australia basically have to review the ledger and when they're looking for non-quape items, because they're not going to go back to every single source document. So you need a very high level of description in your general ledger. And obviously when money's going out to people for petty cash and coming back in, quite often that process is... needs to be in place so that you capture as much information as you can, so that Screen Australia, when they're doing a review, and basically you'll just slow down the whole process if you don't have a great level of documentation, because Screen Australia will come back and go, what's this, I need more information. So the more information you can put into your general ledger, the better. You have to have a general ledger to go in for producer's offset. It's one of the requirements, so you can't just duck in with an Excel spreadsheet or anything like that. It is a requirement that you submit a general ledger. Costs need to be production costs, not distribution costs. The legislation's very specific that the quape are costs incurred in the making of the film and not the distribution of the film. And there are a few exceptions to that, and I'll talk about that in marketing costs below. But basically, once your film's delivered, all your costs pretty much should be there. So any costs in actually getting that film out there are not costs in making the film, they're costs in distributing the film. There are some specific exclusions. Overseas purchases, a lot of overseas purchases are not quapeable. Most overseas shooting costs, I'll talk about the Gallipoli clause down below, but a lot of overseas shooting costs are excluded if you do have to go overseas as part of your shoot. Pretty much all financing costs are excluded. The main financing costs you get are interest on cash flow loans, but there are some other financing costs, like if you've got legals involved. So if there are legals of a lender, then those are excluded. And if you have an EP whose sole purpose was bringing on financing, that EP fee would be excluded as well. So basically, all costs related to the financing of the film excluded. And the last bit is the wrap party. They don't let you claim the wrap party as quape, which is quite a shame. And also any donations or gratuities, like if you've bought a slab of beer to get a location or something like that, that slab of beer unfortunately is not quapeable. There is a 20% cap on above-the-line costs, so above the line being your key creative costs, your writer, producer, director, key cast. You've pretty much always got to have one key cast or one cast member above the line. My experience has been Screen Australia will insist on that, even if you've used, say, this is the first feature this person's acted in. If they're the main character, they'll say, Screen Australia will say they've got to be above the line. But those costs are capped at 20% of the whole budget, and obviously there's, the rationale for that is so again, you don't get the producer going, oh, I'll charge 700,000 for my fee and I'll get 40% of that back. So, that just controls to make sure that, there's no blowing out of expenses above the line. Development expenditure. Development expenditure is one of the spreadsheets that you specifically have to list in the QUAPE spreadsheet. Development expenditure spent overseas is generally not quotable. So if you go overseas for a market or something like that during development, one of the issues with development expenditure I find is documentation. If you've been developing a project for 6 or 7 years, finding that invoice where you've paid a script supervisor 6 years ago can often be problematic. So when people are in development, I encourage them to set up a separate account in their general ledger for development costs for a particular project, so that way you can track development costs. The overheads I did run through a little earlier, but they're basically 5% of the rest of the budget that goes in that you can claim, which is a nice little learner for the producer. There are very specific rules around travel and specifically airfares. Cast coming into the country you can claim, but cast going out you can't claim. If you're bringing people in and then taking them out again to another country, there are rules about that, whether they're Australian or not Australian. So you basically, all your airfares need to get listed as part of the QUAPE application. Pretty much every leg of every airfare for every person gets listed. Music, this one quite often catches up producers in that if you're getting an overseas composer or buying music from overseas, that's not QUAPE. And it's quite often producers go, oh, I didn't think of that, So quite a lot of producers get tripped up on during post, they're buying stuff from overseas, not recognising that it's not QUAPE. The Gallipoli clause, which I briefly referred to earlier, there's specific legislation about if you actually have to go overseas during your shoot to shoot something specific, and they use the example of the movie Gallipoli there, then certain costs of those will QUAPE. So if you take Australian crew over, those costs are going to be QUAPE, but if you actually employ crew over there, they're generally not. So some of the costs will be QUAPable and some won't be. You have to prove that you needed to go overseas. It can't be, oh, well, I was just shooting in a desert and I had to go over to Egypt. Well, we've got desert in Australia. Maybe you didn't have to go down there or something like that. You've actually got to have a defensible reason for why you're going overseas.
Fantasy locations are pretty much out
So-
these days. Just so,
Fantasy
like if you have a fantasy set story,
Yep.
and you say, I want it, even if the location is specific to that story,
Okay.
Screen Australia, in their infinite wisdom, will say that you didn't have to go with that particular location because it's fantasy, it could be anything.
So if you're So if you're shooting in like 14th century Prague and that's where the story is set, and you go, well,
because it has to be Prague.
okay,
But like, I don't want to name names of productions, but yeah, if it's say, I don't know.
Oh, if it's
say
another-
Lord of the Rings.
if it's another planet or something,
What's that?
if it's another planet or
If it's another
something,
planet, you can make anywhere like that other planet.
Okay.
Lord of the Rings, it's your interpretation of what Middle Earth should look like. So
Okay.
it's an interesting exercise. Best to, and that's when provisional Screen Australia should make a decision about that.
okay, great to know. Just gonna sip. It's worth noting the legislation is very specific that a deferral is not considered QUAPE. So if you have somebody who defers their fee, that basically involves saying you will only pay me the fee out of the profits of the film, then it doesn't actually meet the definition of an incurred expenditure, because the expenditure is actually dependent on a future event. So if you have people deferring fees, saying, oh, I'll get paid when you get some money in, those costs aren't QUAPE. So deferrals, which used to be fairly common, are now a lot rarer. And so that's when sometimes people look at reinvesting part of their fee instead of deferring part of their fee and things like that. Costs in a subsequent financial year. Again, if you've delivered in a year, it's very hard to make an argument that costs in the following year are going to be quapable because you've effectively delivered. There are some circumstances where you can do it. So say, for example, if you had an actor who hadn't given you the tax file number until the following year and you couldn't make the payment till the following year, you'd put that in as an incurred expense in the estimate to complete. So there are some expenses. The audit expense is another one. Quite often, you get the invoice in, but the work might not be done till the following year. But generally, most expenses incurred in the year after delivery, you've got to really make an argument with Screen Australia for them to be included, because their position is, well, you've delivered the film, you finished the film, therefore why are you still incurring costs? Are they more likely to be distribution rather than production? Marketing costs is quite interesting in that the overall position is marketing costs are not claimable as QAPE, but then the legislation actually circles back and then specifically includes certain marketing costs as QAPE. So things like your key poster art, your trailer costs, your publicists are specifically included as QAPE, your EPK, things like that. And there are a couple of general sort of bits of legislation about producing additional materials. So if you're doing a behind the scenes, then you can make an argument for including some of those costs as a production cost. So whilst marketing costs generally are considered non-QAPable, there are sort of like several inclusions that you can include them in QAPE. And the last point, which I actually touched on earlier, which is the interested party. If you have people who are an interested party who have an ownership position who are also providing services, then they're separately identified in the QAPE spreadsheet, and Screen Australia will scrutinise those to make sure they're at market rates. And discussion, questions?
Questions for Matthew?
Hello.
Hang on.
Hi, I just had a question about the reinvestments. I guess in particular, reinvestment of overheads or producer fees, but maybe more generally. Clearly, you're going to have matching tax invoices for the service and for sort of the actual investment. Do you always insist that everyone moves cash around, out and back in as well?
No, I've actually raised that specifically with Screen Australia. When the legislation first came in, that Screen Australia actually insisted there was a movement in and out of the bank account for those reinvestment amounts. Screen Australia no longer insists on the cash going in and coming out, so they actually now will accept as part of reinvestment that invoice is being offset. So I rang them about that about a month ago, and that was the answer they gave me on the phone.
Sense prevails. Any other questions? I was just wondering about, and this may be a stupid question, but I'll put it out there, things like residuals and clearance costs, because we say that marketing costs aren't claimable, production costs are. Obviously, some of the residuals and clearances that you're paying are for distribution. Is there any limit to that, like, that you're aware of? You know, some distribution, like clearance costs you're paying during production,
Yep,
under the relevant awards or whatever, and then some costs are coming later down the track. If you're building those, you know, front-loading those costs into the budget, do they then attract QAPE?
I would say yes.
Irrespective of what they relate to. And what about... Yeah, I mean, assuming that they're market level, and then including the 10% streaming loading that gets paid under ATRA after delivery?
Yeah, because that should always be in the budget, even though it's not after delivery, it's at the end of engagement.
Oh, okay. So Rebecca's just said yes, including the 10% streaming loading. That's her view, and we're sticking with it. So we think that we can build in those costs into the budget. They're treated as production costs, not marketing costs.
Yes. Yep.
All right. Well, look, thank you, Matthew. We're going to finish up a little bit early. Can you please put your hands together for Matthew?